So in the morning, we were looking into the features of option as a derivative instrument. We also were discussing about what is the basic difference between option and future. What are the differences? We try to understand some of the terminologies which were connected with options. Right. Now we are looking little into the practical side, how it is through diagrammatic as well as diagrammatic representation as well as through one or two problems, exercises. Okay, so quickly. Now, as we know, payoff, the word meaning of payoff is, what will be the amount that you're going to pay to the party. There can be the buyer and the seller, as we say, a person in the long position as well as the short position, and what will be the final amount that will be paid to these parties. See, and from the beginning, we had been telling that the settlement can be physical as well as cash settlement. In index options, of course, we have only cash settlement. But when we are talking about the general condition, normally it is cash settlement where you are adjusting the differences that has happened because of the fluctuation in the prices. Right. Now we are going into analyzing the different positions like a call option from a long position, a call option from a short position, a put option from a long position, as well as short position. Okay, that's what we are going to look at it first. Now, you can see a diagrammatic representation of an ideal condition that can happen for a buyer of a call option. So he is having a long call. He is a buyer of the right. Okay. So as per our discussions in the morning, buyer of an option who is a call option or put option is having a right to exercise an option, or to having a right to decide whether to exercise an option or not. So that is the right with him, and he do not have an obligation. Now, the person in the short position is under an obligation to do as per the decision taken by the person in the long position. So that's what our discussion concluded in the morning. Now we are going to look into how practically we can just express it. See, when you write for your exam, university exam also, remember that whenever you get a chance, like an essay question or maybe a five-mark question, please, if possible, draw and give a diagrammatic explanation along with the theory. Just don't write the theory alone, because then the examiner will know, yeah, you are thorough with the concept. You can express it well. Likewise, sometimes words may not express it clearly. So if you use certain diagrams or maybe numbers like calculations for explaining, that will be very effective in this subject. Okay, so remember from that perspective also, these things are very important. Yes, now looking here, we can understand that this is an option where the underlying asset is index, Nifty, NSE 50. That's the underlying asset here. And now we can say we have put it as 2,250 for our calculation. Okay, we have put the index as 2,250. So the contract is entered, and when we are looking from the buyer's perspective, okay, from the buyer's perspective, there are chances of unlimited profit if the price increase above 2,250, right? Because he has agreed the underlying asset to be purchased, here the index to be purchased at 2,250, maybe in 1 month period, maybe in 2 month period, maybe in 3 month period. Now during the at the final date, exercise date, if the underlying asset is trading above 2,250 to whatever level, maybe it can become 2,600, it can become 2,300, whatever maybe. That's why we put this line like this. He has the maybe the opportunity to gain, to have unlimited gain, depending on how the Nifty moves in that stipulated time span. Okay, so if it is about 2,250, above the strike price. If the spot price on the exercise date is above the strike price, this person is going to make profit. This person who is having a profile of buyer of a call option. Why he is going to get that profit? Because he is going to get an asset which costs more than 2,250 at 2,250. So the very moment, normally what happens here is only the difference is settled between the parties, two parties. Whatever the difference, suppose if it is 2,350, the 100 rupee for each is being transferred to the buyer. That's how it happens in cash settlement. But what you can think, what it will enable you to remember this condition is on that spot, he can sell that asset, the same asset which he bought for 2,250 at 2,350. So he's going to gain, he's making profit. So that is the condition of unlimited profit. As if Nifty is very bullish, there is possibility of unlimited gain. Now, what is the maximum loss that can happen to him? It is the premium, the price which he has paid to the seller of the option for selling him the right to buy. For selling the right, he has paid something called as premium. So this 86.60 per share is the maximum loss he can incur when he is trying to exit it. Why? Because if the price is below this, below 2,250, he has the chance or he has the right to go with not exercising the option. He can decide whether he is going to exercise it or not. In this case, he can decide that he is not going to exercise it. Why? Because the price in market, the same product is available at a lesser cost. So he can straight away enter into the market and buy. Why should he observe the contract? So that's why in this contract, what we would be saying is this buyer, the maximum loss that can happen to him at this point is 86.60. Why? Because this he has already paid at the time of entering into the contract, the premium price being given to the seller of the right, and he is not going to return it. That is the only profit, maximum profit, which he can expect if this person is going to exercise. Okay, so here this is the case of payoff profile for the buyer of call option. Maximum, he is having unlimited opportunities for making profit. At the same time, the maximum loss that can occur to him, because he is having the right, the maximum loss that can occur to him is 86.60. Okay, so this is the payoff profile for the buyer of call option. Now we are going to look at payoff profile of the seller of the same call option, that is the person who is in short position, the counterparty. Okay, we are going to look at that. Now you can see the change in the diagram. That was unlimited profit. This is unlimited loss. Why? If this party, so suppose if the price becomes 2,000, as you say, no, maybe 2,700, the other party will definitely exercise the contract, because this person is forced to sell an asset costing 2,700 and 2,200 and 250 to the party. So that means he is incurring a huge loss. So that is why the maximum profit this person can expect is 86.60, the premium money which he received when he sold his right. But his loss is unlimited depending upon the movement of Nifty. Now you might be wanting to ask then, why should this person go for it? This is actually a speculation. This is a speculative market where they are just looking at calculated risk. This person who is entering into a contract would be benefited in such a case that if the Nifty falls below 2,250, he's in a gain. Why? The person who is having right most probably won't exercise it. So the person in the short position is getting a premium of 86.60 per share. At the same time, he's having the asset with him. At some point, the price may go up. Then he can sell that in the market. Correct. So that is the kind of expectation this person is having. Right? He has sold his right for profit. So that can be a condition which this person is expecting. One, but the thing is, if the market is in the opposite direction, it goes into a bullish trend. Definitely, this person is going to have unlimited loss to whatever extent it has gone. Say 2,250 when we went to, say, as you say, 2,500. So he is losing 250 for each share which he has to pay to the person in the long position. Right? What is left with, what he is left with is only the premium money. So this is the payoff position of parties, both the long position and the short position in a call option. Okay. Now we are slowly moving into the payoff position or payoff profession. Now he is also called as a writer of the call option. Now the next one, what we are going to discuss is payoff profile for the put option, both long and short position. So put, we know that it's for selling. Now let's look at that. Now payoff profile for the buyer of put option, that is long put. Here in this case, this person, put is for selling. This person would be selling or exercising his right if the price goes below this, or if the price is at par. If it is above this, above 2,250, he will not exercise. The reason here is he maximum what he is going to lose is only 86.60. The rest, if the price is 2,500, he can exit from the auction and sell that immediately in the spot market. He should not go to a derivative market. He can sell that in the spot market, or maybe he can enter into another agreement for a future date, another contract for a future date. So when this person is having the right, he will exercise it only when the spot price travels below this, which means he is able to sell an asset presently which is having less value than 2,250, but he can sell that at 2,250. That's why we say that he has unlimited profit, opportunity for unlimited profit. As the share price decrease, that will be the difference which he is going to get. But what about the loss? The maximum loss possible for him by not exercising the contract is 86.60. That is a premium he has paid to the person in the short position. So that is a maximum loss which he can expect. Okay, so that's what we call as the payoff profile for the buyer of put options. The aspect here is when you are talking about selling, you will not exercise your right if the selling price increases above the strike price. If it is traveling below the strike price, then you have unlimited possibility of making profit. As it travels down, you're making profit. So that's how the profile for the buyer of put option when you are having a long put. Now the same when you are having a short put, it's just the opposite. Why? Because this person, he can, the person who was sold out sold out his right, can expect that person exercising, the other person exercising the contract when the share price travels behind 2,250. In that case, he has the unlimited possibility of incurring loss. How much ever it travels down, that much he is going to. Suppose it reaches to a place like 1,000. In one day it will not happen, but in 1 month it can happen. It reached to 1,000. Then what happens here is, this person, the other person definitely will be exercising this trade because the price is low. But if it is no, for him, he can look at this case where if the price is above 2,250, in that case, no, as you say, no, if the price goes up 2,250, that person, he can exercise that maybe by exiting from here and exercise that in the spot market for getting more profit. He need not no go with selling that at 2,250. But if the price goes down, he will exercise it, and this person will be in a position to occupy that. So he is no, he is committed to that. So the possibility of incurring loss would be huge, and the maximum profit which he can expect here is this 8660, which he would be getting when he's no selling his right, when he is actually giving his right to the other party for selling the asset, for deciding upon selling. That is one party here who is in the short position always will be selling the right to the other party who is in the long position. So to summarize this position, the person in the long position will be enjoying the possibilities of getting huge profit, whereas the person in the short position is prone to unlimited losses. And the maximum possible return which he can expect is, but there are different types of trade which covering up and all, covered option and all, which we are not going in detail now. But as of now, he can expect the maximum profit, that is the premium price, which he got at the time of selling the right. Okay, so we were trying to discuss about four conditions. One is payoff when it is happening for a buyer of a call option. Then we discussed payoff condition that is happening for a seller, that is put option, for the buyer of a put option. Okay, that is long put. And then we also discussed about payoff for the seller of put option, that is short position, and seller of a call option, that is short call. Okay, so these were the four conditions. Now we are looking into a practical exercise. Okay, now look at this condition. A call option with an exercise price of 1,000 at a premium of 50. So this is actually the premium paid by this investor when he is purchasing the right. If the spot price on the date of transaction is 980, so the strike price, okay, the underlying asset of the price at the date of entering into contract is 980. Okay, so the exercise price, which is decided upon many factors other than that, that is the lot. The call option with an exercise price of 1,000 at a premium of 15 is purchased by an investor. Now the spot price is 980. So at that time, the spot price of that asset is 980. One in that category. Okay, and so on. Now look at the condition. Calculate now the share price on expiry, which might happen to be like there are different conditions that has been given to us. Like share price can become 1,000, 1,020, or it can become 1,040, or it can become 1,060, 1,080, 980, 960, 940, and it goes like that. Okay, but the spot price at that time was 980. That's our landmark. When we entered the underlying asset, the spot price was 980. Okay, calculate the intrinsic value and time value. Now we have learned the concept of intrinsic value, right? And we have learned the concept of time value, right? So we are going to do that, just putting that into a table. So this is the scenario which you have to look into. And now we have spot price underlying. Okay, the first condition that was given to our question is 940. We put that in the as we call ascending order, 940. So 940, in the sense we are going to say that condition as out of the money, because our underlying asset was purchased for 980 rupees. Okay, this is actually, see, it is call option. This is call option. So option for purchasing the asset, right? So currently the asset is trading at 940, but we are promised to no, by the counterparty we are promised to sell the asset at 980. Now this is out of the money. Why? The question here is it a wise decision to buy the asset at 980 rupees when it is trading in the market at 940? It's not a wise decision. Why? From the market I can buy it for 940. Why should I go and exercise my right by buying the asset at 980? That is where we call that it is out of the money, because if I exercise that, I have no gross profit, no value, no gross profit, no inflow, and my loss will be 15 rupees, which I've already paid. My loss would be 15 rupees because I've paid 15 rupees as my premium. Right? So if the price is 940 and if the strike price where I entered it is if 980, then that will be OTM. That is out of the money, because this person, there is no point in exercising that contract, because you are purchasing the same asset for 980 rupees, which is available in the market at 940. So your loss is 15. You are not going to exercise. That is out of the money. 960. Again, the same condition. You are promised to buy the asset at 980, but the asset is trading in the market at 960. Out of the money. The loss is 15 rupees, which you have paid as premium. Then 980. 980 in the sense where when you are looking at, okay, it is you already had paid 15 rupees. Right. So when you are looking at your promise, your transaction is 980, but you are already paid 15 rupees. So it is, you can design, but still it's not appealing to you. It's no, the same asset, because your asset cost when you are buying it is 980 plus 15. So you thought you are going to leave that 15 and just leave it. But when it is, that again is considered to be out of the money. But reaching at 1000, there you become no profitable, because you are offered an asset at 980 rupees. You can buy an asset at 980 rupees, which is trading in the market at 1000 rupees. So on the spot, if you sell, you can have a profit of 120. No, yeah, 980, 20 rupees on the spot. Okay, so it is as you say, no, there is a problem here. The exercise price is 1000. Yeah, sorry. Here the exercise price, the strike price is 1000. I took it as, no, I correct it. Okay, I will just repeat it, because I took the strike price as 980. The strike price is 1000 in this case. Call option with an exercise price of 1000. Okay, so I'm sorry, I'll just repeat it. Sorry. Now, what you have to is you have to look in from the perspective of 1000 rupees. I took 980 as our strike price, so I corrected. See here, imagine the first from the first, where our strike, your spot price here is 940, but our strike, the logic remains same, but the amount I took was wrong. So the first part is your strike price, it is 1000, but here it is trading in the market for 940. So you decide it is out of the money. Why? Because you can buy it from the market at 940. Instead, you are promised for 1000. Same as the case 960. You decide not to not to exercise your right. It is out of the money, because in the market you get the asset at 960. 980, same as the case, you decide not to exercise because it is available in the market at 980 rupees, and the actual strike price is 1000. Then in case of 1000, here it is at par. Okay, you are going at par, and what happens here is you have a loss. Okay, you have a loss. The time value can be considered. So if you are going to exercise, you will have a loss of 15. Okay, so it is up to you to decide. Sometimes you might decide because in future you expect a rise in the price. But if that is not the case, you can also, because that's your break even not exactly the break even, but when you look at the strike price and the spot price, it is almost like BEP. Right. So it is your decision at this point whether to incur that 15 rupees loss or not, which you have paid as your premium. Now, the next three comes with the category of giving you an opportunity to make profit. That is, that situation is what we call as in the money. So, for example, the strike price is 1000, and what happens here is it is trading in the market at 1020. So, you are promised with an asset at 1000, which if you want, you can sell in the market and gain 1020. So that there you are in a comfortable position, and that is said to be in the money. So 1020 minus 1000 will give your intrinsic value, which is 20. But your time value would be, as we say, 20 minus 15, which will give you 5. Till you have a benefit of 5 for each. Maybe in a lot when you are buying this, we have simplified by just one. But in actual market, a lot size might be your strike price might be coming to a value of 2 lakh or 2,50,000. So that difference will happen in the on a day, maybe in a 3 days, or maybe in a month. In 2 months, you're going to make a profit of 10,000 or 20,000, as it depends on the market movement. So that is the plus point with the respect to. Now the condition is 1040. In the market, it is trading at 1040. Your strike price is 1000. So what happens here is naturally you have been given with a bonus. So you go with exercising that, and you get a profit of your intrinsic value is 40. Again, when you consider the time value, the rest is your 15, 25 being kept as your, as you say, profit, the actual profit which you can make in one term. Same as it goes with 1060, and when it is in the money, because here in this case also strike price is 1000, but your actual price is which is in the spot market is 1060. So you get an opportunity to purchase the asset at 1000, which is having actual value of 1060. So your profit will be, as for each share, it will be 60, and then from that what you do is you reduce your premium which you have already paid to the party, so it will be 45. So that is actually the power of right which you get through an option. So it depends upon, because you have unlimited opportunity to make profit, provided your expectations are going in the right channel. Because a buyer in a call market always will be expecting a bullish market. Unfortunately, if the market did not go in a bullish trend, it went in a bearish trend, then you're going to lose the maximum of the premium he has. But that might be a loss, a considerable amount when you have, say, in a lot size 1000 shares, or maybe 2500 shares. So 15 each or 20 each. It's a lump sum amount which you might lose simply in a time period of 3 months. Right. So you have to take calculated risk. You have to understand the pulse of the market before you decide whether you are going to have a long position with call or put. Why? Because put is good when you are thinking about a bearish trend. Call is good when you are thinking about a bullish trend. So you have to identify the pulse of the market before you go. So I just repeat it once more because I had confused you at the beginning with the 980. So here as the call option with an exercise price of 1000, and the underlying asset is trading at 980 rupees. Now that 980 is the pulse. This 980 can go above or below. depending upon how it is traded in the market. Depending upon the trends in the market. So in this particular case, we are looking at different price movements starting from 940 to 1060. Now we have one as the spot price, we have one as the as we call as the strike price. Okay, so the moment of the future spot price is our identity for deciding whether you are having or whether we are having a profitable position or a loss position, whether we go with the payoff or whether we go out with us without exercising our option. That's right. So in this case, when as you say, when the spot price on the exercise date, okay, maybe our exercise date is today. So when we are looking at, we found that it has become 940. But if you're going to exercise the option, we have to pay 1000. We already paid 15, right? So it is not wise to go with purchasing an asset which costs 940 now in the market and buying it for 1000. Okay, and then the same goes with the case of 960. That is, we are going to pay 1000 rupees, but same thing we can get in the market at 960. So again, that is out of the money. Now let me just explain the same thing when it happens for put option. Okay, long put, the same thing. Okay, long put, here also you pay 15 rupees for buying the right, but here it is not called, it is put. Okay, so the strike price is 1000. The strike price is 1000 and the current spot price is 940. Then that is actually in the money. Why? Because you are promised you are promised by another person to take up this asset at 1000 rupees when it is trading in the market at 940. So you will exercise the option, so it is in the money. The same condition and just reverse the position. You will exercise it. The same in 960 and the strike price is 1000. So naturally, you are actually, that is the reason why you entered into this contract. That is the reason why you have decided that you're going with a long put. So you can sell your asset at 1000, but in the market, it carries a value of 960 only. So it is in the money. But you look at 1060, the condition reverse. You are actually selling your asset at 1000, but if you can get 1060 if you don't exercise your option. So which would be good? You won't exercise this option. So that is why we call this condition as out of the money. Out of the money condition, because you're forced to sell an asset which has a value of 1060, but you are selling it for 1000 rupees. That will not happen. So that is where this condition has changed when we change that into a long put, right? So this is actually the payoff position which we were trying to explain at the beginning of our class. So to conclude, just look for one more time. The payoff position of a buyer would be like this. See, the buyer, if it goes beyond this, he is in a profitable venture. He is able to buy an asset which costs more than this 2250, that is the strike price. What he can get is he can get that at a price 2250. If it become 2500, if Nifty goes to 2500, yes, definitely he would be exercising that option, and that is called as in the money. Because the price is high, the asset value is high, you're getting at a lesser price. That position is what we call as in the money. But if it goes below this 2250, below this, then it is something called as out of the money, because he is actually buying an asset which is having a value less than that. He will not exercise his contract. He will exit by losing premium 86.60. Then if it is 2,250, that is called as at the money. Okay. Now here in this case, again, no, this is, he is supposed to, depending on the condition of the other party. So he has no choice here. This person, the person in short call or short put, does not have a voice. So we will explain here. Whatever the other person decides, he has to observe, right? So there is no point in going with that. Now we will look into this condition. This is actually the buyer of a put option. So for him, he will be looking at if the asset price goes below that, below 2,250. Here, if it is like, maybe if it is 2,000, it is called as in the money. And if it is beyond, say, 2,500, it will be out of the money, because he can sell the asset in the market at 2,500. Why should he sacrifice and sell that at 2,250? So that will be the position. So that's the case of, and if it is 2,250, that's what we call as at the money. Okay. Now, when he is planning to exit, the maximum loss that can occur to him is 86.60.